warm in here today. I think before we start, oh, we're here. We've started. Okay. Can you open the window? Thanks. I did it on live. The whole world knows we opened the window and broke the rules. Who knows what else will happen in Ways and Means? Breaking those rules. Okay, so I'm going to call us to order. We're live. Here we are in the Ways and Means Committee. It is May 5th at 1:15. What are we going to do this week? This week, we are going to work on a number of bills that are coming from other committees, Senate bills mostly. And then some House bills that have come back a second time. So those are sprinkled throughout. They're going to move around as other committees move slower or faster than anticipated. Most of those will have a vote fairly quickly. So let me know if you have anything on any of them, please. Because a lot of staff is quite busy in the Senate this time of year. And then we're going to do another run through of miscellaneous tax today. I thought it'd be helpful to go through the whole bill, not just the Senate's amendments, so we can remember what was in there, because sometimes that's nice. And then probably do a straw, if it makes sense, we'll do a straw poll on our decisions on that. And then similarly, tomorrow we have that same plan for the yield bill. And that is all my announcements. Yes, Representative Brannigan.
So are you thinking we will vote both of those big bills out of here by Thursday?
I'm thinking we'll decide whether we're gonna offer a further amendment or go to a conference committee by Thursday.
By Thursday, cool,
Mhm.
great.
That doesn't mean that we're any closer to adjournment, Representative Brannigan.
Oh, well,
Yeah.
so should I try and put the peas in the garden this weekend?
I do that. Yes.
Yeah, okay.
Yeah. I think Mother's Day is actually always a good time to put the peas in the garden anyway,
Okay,
because then people help
oh, good.
without complaining, at least in my house. With that, Pat.
Garden tips, Ways and Means.
Parenting tips.
We're on the, we are.
Oh, guys, it is only Tuesday.
Didn't realize.
So I am Patrick Turchin with the Joint Fiscal Office. There are two documents on my name on the committee's page. One, where I think we'll start, is a bunch of slides that are going to kind of walk us through again where, this session sort of started with respect to HR 1. What things you all as a committee identified as going through and how you needed to react to them and what the overall budget picture looks like in the context of the conversation about conformity. And yeah, we'll look at some slides that I know you've seen before, but just kind of remembering some of the very specific policy decisions you all made and the revenue impacts those had. And then I guess from there, there is a draft version of the fiscal note. We're just waiting on the official language to get posted to the GA page so we can link to it. But if there are more questions that maybe we can answer through the fiscal note, we can maybe migrate to that. So just starting sort of high level, the initial question, how did federal tax changes flow through to Vermont? This is where that concept of something being above or below the line comes into play. What specific HR 1 or changes in HR 1 were expected to have an impact in Vermont? And then lastly, how did you all propose to deal with those changes? And I'll point out a couple of things that came back from the Senate that are, a little different than what you passed out. So starting with personal income taxes and the question about whether something flows through or not. Personal income taxes start federally on the 1040 form. And so what this form does is it basically takes all of your different types of income, adds them all together to ultimately get to that line 11A, which you see at the bottom there. Line 11A is the starting point of Vermont personal income taxes. So if something is above the line, meaning anything in lines 1 through 10, that's something that you would expect to have an impact on Vermont. Because again, our starting point is that 11A. And then there's also changes the feds can make that would be considered below the line. These are all adjustments to income that happen either through deductions or exemptions or credits that happen after the starting point for Vermont taxes. So changes there don't actually flow through and affect us. And this is why some of like the proposal or some of the policy in HR one that got a lot of media attention, like the overtime, taxes on tips. Those are all things that were showing up in this 13B line. So again, below the line, things that would not have an effect on Vermont would not flow through. So when you hear the term above or below the line, it's very literally a line. Yeah, so once you get to Vermont taxes, again, that 11A is your federal adjusted gross income where we start. We do have some additions that we make, we do add back bonus depreciation. Under current law, and I know there's some bonus depreciation in HR 1 that you passed out with similar treatment, but current law, we're adding back in bonus depreciation and interest from non-Vermont state and local bonds. And then there are subtractions that we make, like for the Social Security exemption, personal exemptions, standard deduction, things like that, which gets you to your Vermont taxable income. Taxable income is what we run through our marginal brackets. I know you're very familiar with this, I was just in here quite a few times talking about brackets with you all. And so once you get through the bracket, you have your initial tax liability, which then is where you get into the conversations about tax credits, whether they're refundable or non-refundable, to get your ultimate, tax liability. So that's just kind of like a quick run through of why certain Fed changes on personal income taxes matter in the context of state revenues and why some of them do not. Corporate income, that was the area this committee actually spent most of their time when thinking about HR 1. Similar kind of concept, there's a Form 1120. It's kind of like a corporation's version of the 1040. The first half of the form, stating all the different kinds of revenue streams that the corporation might have, putting them all together to get total income. But with running a business, you all know that revenue, generally speaking, is not sort of an indication of income, right? Because you have to think about net income once you account for any deductions or expenses, what have you. So the reason that, Vermont sort of saw a lot more impact from a lot of these federal corporate changes is that our starting point is further down on the form. That taxable income line you see there, 28, that's where we start. So all of the HR 1 policies having to do with the deductions or amortization, a lot of those are going to be showing up in these lines 12 through 27. For example, depreciation's right there. There were some changes made to that. And charitable contributions, there are some more changes made to that as well. So that's why, a lot of the discussion in this committee did end up being around business and corporate income, because a lot of the provisions in that space were set to flow through to Vermont. And I always like to include this slide, just a reminder with the apportionment. So you take that line 28, that becomes this left hand of the equation here, your US federal taxable income. Then because we have single sales factor, you're basically reducing your overall income amount proportionally to how much you're selling into Vermont as a market. So again, the system's very sort of agnostic about where a business is located. Really, the corporation's tax liability is, solely driven by sales into the Vermont market. So it's kind of like a tax on, access to a market fee kind of thing. That's that. I had another word for it, but it's escaping me. Okay. Again, we have marginal rates. There are minimum taxes based on gross receipts. This is just standing law. None of this was affected by anything in HR 1. So that's sort of the conversation about things that flow through, things that do not. Next, I just want to revisit sort of why this was such an important conversation this year. We'll go through each of these in detail on what the committee decided to respond with. But you can see that there's a bunch of provisions here that were set to flow through because of HR 1. And assuming normal conformity, meaning linking up to everything and treating everything the same way the feds are, that would have put, a $21 million hole for fiscal year 26. Remember at the time, the legislature had just put through the budget adjustment. So that $21 million not accounted for in budget adjustment. And then looking ahead for fiscal year 27, that $33 million you see there was not, there was no adjustment in the consensus forecast to account for that. So the budget making process at that point would have been at a starting point of a $33 million hole. So that's where your work, I'm sure, is appreciated by your colleagues on appropriations in responding to it. Yeah, and part of, if you remember back to early January, these impacts looked a lot more muted, as more information was collected and we saw more receipts both federally and other states. It became very clear that a few of these provisions in particular R&E, were really going to be substantial cost drivers to the state revenues, which, really did juice these numbers quite a bit overall.
Can you just say again how you came about the calculations? That you rely on another third party to help you understand what it could be, right?
Well, I think the starting point for us, and honestly, from talking to other states, the starting point for most states was the JCT estimates that were produced after the bill was passed. Obviously, there's things that come with that are not typically how we'd like to approach estimating. For example, what is an appropriate way to look at these national estimates and put them in the context of Vermont as a state, right? And really at the time, and any other state would tell you this, we really had a dearth of information and flying a little bit blind. So it was really once we started seeing actual federal reports on receipts, looking at how other states, corporate revenues were performing, the context of whether was that state coupled? If so, they were seeing some of the negative impacts and softness in their revenues. States that were static were kind of chugging along like nothing had really changed for them. So really sort of weren't seeing some of those impacts. So in Vermont being sort of a rolling static-y kind of thing, it's an important, it's why you come back, look critically at changes that might have happened federally and decide, does this work in Vermont's context, right? So, okay. So the language, as it's coming back to you from the Senate, looks very similar to what you passed out, talking about the revenue pieces of it. So it's linking Vermont up to the federal changes around the child dependent care credit expansion, the amended limitation on business interest deduction, the expenses of depreciable assets, that provision for small businesses, pro rata share rules, charitable deductions, the domestic research and experimental procedures deduction, that I'll just highlight again, was a very big ticket item. And we'll go through it, but you remember for small businesses, you were opting to link up, but for larger ones, you were saying they had to maintain that 5-year amortization of those expenses. And the Senate has passed that language back to you. There was also language that you all passed out that is largely intact, minus one little tweak to qualified small business stock. And that was the R&E for non-small businesses. The special depreciation for qualified production property, If you remember back when tax first came in about this was actually an area that where they were requesting to decouple because it's consistent treatment with how Vermont does other forms of bonus depreciation. And then there's the international section 250 deduction changes that you all passed out. And sort of not the three items that are sort of not direct responses to HR1, but are included in the bill. One was the increase in the downtown village tax credits. You had passed $1 million. The Senate had just handed you back 500,000 expansion. And then the increase in the research and development credit from 27 to 75% of the federal amount, that has come back to you intact. And then also the down payment assistance program language that you had has come back to you in the same form. So next, what I'm going to do is tell you what exactly those, I just listed them off, but what exactly were those federal changes? What were they going to do? And how did you opt to respond? So there was language. So the one personal income piece that wasn't business related was the child and dependent care credit. There was an expansion of the phase down. And remember, Vermont has a set percentage of the federal credit. So while it's below the line on the federal form, it's similar to the EITC where we just take a straight percentage of the federal credit. So changes to the formula and structure when we are linked in that particular way do flow through. But so what HR1 was expanded the maximum credit rate from to 50% from 35. That amount only applies to very low income folks. You'll see on the next slide how the changes in the phase downs look, but so there was some changes to basically the phase down, and that was driving most of the cost. There is $1 million cost estimate associated with this. Currently, this program costs about $4.8 million annually. So combined, it will be approaching about $6 million for the CDCC. And again, the language that you have is conforming to the federal changes. And so this is sort of what the difference in the phase down looks like. You can see that, so green refers to TCJA treatment and what the phase down looks like. And then the blue and orange dotted lines are the changes made that will flow through. You can see up to about 15,000 is where the 50% credit rate is applied. It then phases down to about 45, at about 45,000 in income. It's down to about 35%, and then again continues to phase down, not phase out, till the credit rate is about 20%. So that's a change that will flow through. There's the amended limitation on business interest deduction. So HR1 expanded the limit to how much of this interest you can deduct, and it's interest paid on loans for business purposes specifically. And so the limit on the interest deductions is limited by either the sum of its business interest income, the floor plan financing interest they pay, that refers to car dealerships, and then 30% of their adjusted taxable income. So it's the lesser of those three caps. And what HR1 did was expand from 30% of that interest being able to be deducted to 50%. This language does conform to what the federal expansion. And again, this is one of those areas where the tax department did come in and tell you that decoupling from this area would have been very administratively challenging for them. There's the limitation on expensing for depreciable business assets. Again, this is specifically for smaller businesses, but instead of depreciating an asset over its useful life, these small businesses can expense that amount fully, up to $2.5 million of it. Previously had been $1 million. The expansion saying, okay, now you can expense up to 2.5 rather than using the depreciation schedule. And again, so the language in the miscellaneous tax bill does conform to the federal treatment here. Again, being another area where the tax department said that decoupling would have been very administratively challenging. Okay, so changes to pro rata shares. So HR1 changes the treatment of controlled foreign corporations. Just as a reminder, a CFC is a CFC. If at least 50% of the voting power or value of the stock is held by US shareholders. And so basically what the federal changes were doing was it was requiring US shareholders to include in their gross income their pro rata share of the CFC's passive income. Basically, some passive income from the CFC that was previously not required to be included in gross income. So you'll see when we get to the larger table, this isn't a big sort of overall money change, but in effect, what it's doing for those shareholders who have this income and are paying Vermont taxes, it will increase their income that they're reporting. So having a positive tax implication for Vermont. Stuck. There we go. Okay. So the deduction for domestic research and experimental expenses. So just doing the brief history on this one, prior to TCJA, firms could fully deduct these expenses in the year that they were incurred. TCJA changed that so that starting in 2022, corporations or businesses would have to amortize those expenses over a 5-year schedule. Excuse me. What HR1 is saying is that we're going to go back to pre-TCJA. You can fully expense it in the year that it's incurred. And in addition, any costs that you had been amortizing, you can retroactively go back and deduct those as well. So in effect, if you're looking at this change on a really long-term horizon, it basically is shifting cost and over a long period of time would likely be revenue neutral overall. However, given the retroactivity, given the change from current practice, what this wouldn't have in effect have done is really front load a lot of those costs because firms are not spreading it out and they're retroactively deducting a lot of the expenses. So in the slide a little further up when we were talking about what would normal conformity look like, to see a really big number in year 1, a really big number in year 2. But if we were to expand that, you'd see it sort of gradually going down over time. But full conformity would have been about a $20 million a year front-loaded cost, and that was really what was driving some of the big numbers, big negative numbers in fiscal year 26 and 27. So the language that this committee passed and has been passed back to you would conform Vermont with federal treatment for small businesses only, but decouple and require larger corporations to continue amortizing. So basically continue doing what you've been doing, but for smaller businesses, we are going to allow the ability to fully expense, including the retroactive expenses for R&E expenses. And so quickly, just what is a small business? It is a definition in federal statute. And it's a business with average annual gross receipts, so general revenue, over 3 years. So the average per year, not exceeding $31 million. And that figure is pegged to inflation. So that gets adjusted a little bit every year. Yeah, so I mean, that's sort of the nuts and bolts of this provision. I know it's probably the one that we spent the most time in here together in this committee. But sort of the solution was to bifurcate the two types of companies, allowing for the small ones to take advantage sort of in the short term of the expanded ability to deduct.
And the Senate left this intact, yeah.
The Senate did not touch it. I need to remember if Kirby had one technical change that they made to
I
it.
think it was QSBS, but the technical.
I think there might have been another technical one, but I've deferred it.
Okay.
Had something to do with double dipping essentially, and something the tax department had
Oh, for
identified.
the transition.
For the transition, exactly, yeah. So it's, in effect, it has not been touched for your purposes, yeah. Okay, So there's special depreciation allowance for qualified production property. This is basically just bonus depreciation for this type of qualified production property. Think manufacturers of agriculture, refining, other kind of chemical plants. That's the kind of qualified production property in what has changed in HR1. But in a sense, what it's doing is instead of amortizing that property over a 39-year schedule, what the feds are now allowing taxpayers to do is fully depreciate the value of that property all the way up front. And again, so this is essentially a new type of special depreciation or bonus depreciation that the feds are now allowing. Vermont generally does not allow bonus depreciation. You saw in the previous slides that we actually add back and require that taxpayers amortize or depreciate over that time frame. So tax department asked for this to be decoupled to be consistent with how Vermont treats other types of bonus depreciation. And again, this is another area where not in year one, but if you're looking at year 2, year 3, this was one thing we identified as potentially having quite a big fiscal impact looking forward. And so, yeah, the language that you all passed out decouples, but does still allow these taxpayers to depreciate over their schedule like you do with other types of bonus depreciation.
Yeah, on the bullets, small business bullets. Find with an annual gross receipt of over 3 years would not exceed 31 million, that's annual. That seems to me fairly large. What's the percentage of small versus large in Vermont? Roughly. I'm just trying to get a handle.
In terms of taxable income or in terms of number of businesses? Like the
I guess
counts.
I'd say number.
For both, you could answer both questions.
I don't know what's.
I know the taxable income is more, it's like 90% large and maybe
Okay.
10 or less percent small. The count split I don't have with me right now, but that is more closer to like 50-50, 60-40 split.
I would have guessed the percentage was different, so your answer is helpful.
Okay.
That's good. Put things in context.
And I'll just mention again, it's 31 million in gross receipts. That doesn't mean it's
That's right.
31 in profit,
Right.
like net
Yeah.
income.
That's good still.
Yeah.
Bigger than me. Anyway, thank you.
Okay, so the next piece, the exclusion on gains from qualified small business stock. So HR1 expanded the amount of aggregate gross assets that a company could have to qualify to issue qualified small business stock. Went from 50 million in aggregate gross assets to 75 million. So a larger company would be able to qualify to issue this type of stock. And it also changed. So before HR1, if you held that stock for at least 5 years, any gains that you got from it would be completely untaxed. What HR1 did, so it expanded the size of the companies that qualify and also that after 3 years, you can exclude 50% of those capital gains if you hold it for 75, 500%, so on. And so this is actually an area in your language that you had opted to decouple from. I mean, you did a couple of different things. You said this gains from this type of stock sale need to be included in your gross income calculation, but you would allow the 40% up to 350,000 capital gains exclusion to apply to these capital gains. Generally speaking, stocks are not eligible for that exclusion. So it is still in the Vermont code giving these gains some form of preferential treatment, just not the complete non-taxability that the feds are providing. And so the Senate did make one change in this area. It had to do with the effective date. Pretty much everything in the conforming and decoupling language has an effective date for January 1, 2025. So applying to tax years on and after 2025. What the Senate did was for this particular provision, they moved that effective date up 1 year, so to January of this year. And in doing so, it doesn't change the tables, the revenue summary tables that we have. But just to be clear, it does mean that there will be some revenue that would have otherwise been collected that is not collected. And so why does it not change the tables? In that first year, we weren't confident in the ability to actually, from a cash flow perspective, actually realize any of this money. The tax department's ability to collect it, really. Not throwing any shade at them, it's just, this takes an administrative and education process. It's not that they're incapable, right? And so there's that. It's something that Deputy Commissioner Samaroff has said this, said it most recently to finance. They get the federal runs from the IRS that has this information for them. They'll get the runs for that year in about 3 years. So between now, we'll be saying it was effective, and 3 years from now, and there's also going to be some auditing and compliance the department would be doing in between, could not with any confidence say when that money would show up. So it's really hard to sort of allocate that to fiscal year. So it's kind of a long way of saying this sort of change, which normally you would expect to change revenue estimates, doesn't change this table, and a lot of that is due to uncertainty. Does that kind of track? So that's why we weren't showing any change. But again, I'll just say, by bumping it out a year, it does mean that some revenue that would have otherwise been collected at some point will not be collected for that 1 year.
Is this a measure that you think people and businesses will be confident to in terms of their behaviors? And how does it work if the first 3 years of their business growth is in Vermont, the last 2 are in another state?
Well, generally the state taxes work generally on domicile, so where they're domiciled is important.
So my point, if they move, none of this would be relevant.
It could be relevant if it's a Vermont-based business, I suppose. And sort of some of those non-resident returns that do sometimes have to get filed. But nothing. So I mean, I guess a couple of things. This income from selling this stock is still, very preferably treated on the federal level. It's not taxable, right? So that's one thing. Someone who lives outside of Vermont but buys QSBS from a Vermont business, there's questions about allocation there that often come up. And the same is for a Vermonter who buys QSBS stock for an out-of-state company, right? All of this kind of, domicile is very important, but there are, non-resident returns that kind of sometimes factor in here. Did I answer your question? Sort of.
I think none of us really knows what people do.
And I know, I guess, I don't know if you've heard this context, but what was argued to Senate Finance was that people who had made decisions to sell their stock in 2025, understanding that it wasn't taxable, were upset by that treatment. So again, one of the reasons why the Senate decided to push this out a year, just for narrative. So there's the Section 250 deductions. This is the international income. There's the two pieces. It's the foreign derived deduction eligible income, or FDII.
Yeah, sorry.
So will the tax department be able to tell us how much was paid for that? When people.
For QSBS?
Yeah, when people say to themselves, like, we're selling now. Push out to tax year 2026. Can they tell us what amount?
Well, so I guess I'd just say, the effective date is being pushed out to January 1 of 2026. So even that is already retrospective.
To the 10 years.
Yeah. And when the language first came out, we were already past 2025 when decisions to sell would have already been made. So
So somebody can't take advantage of that, push out to 26, really? I don't understand.
It
I
was-
thought I was following.
so part of the sort of feedback that the finance committee got was that people had already made decisions to sell this stock in 2025 under the assumption that it was not taxable. So that they had already sold, and then, with all the other conforming and decoupling language we have in here needing to be retroactive to January 1 of 2025 for, consistency with federal code reasons and, sort of cash flow reasons and administration reasons for Vermont. That was an area where, there was a little bit more control over when we had to make the effective date for. But really the feedback the finance committee got was from some people who had made a decision to sell this stock in 25 under the assumption that they wouldn't be getting taxed.
Now they can't unsell it.
Well, the language here for anyone who did sell in 2025, the language here is not making that taxable because it's moving the effective date up.
That's what I understood in the beginning.
So tax year 25
So
still
we're not
maintains
making-
federal.
We're not making tax changes retroactive to the beginning of the year.
Okay, got it. That's what I thought made sense, but then I.
It always helps to talk things through a couple times. So there's section 250 deduction, there was the two pieces. There's foreign derived deduction eligible income, that's FIDE, and then there's the net CFC tested income or NECD, or NECD. Basically what was happening here was deduction amount, the deduction percentages were being decreased while the base definition of what this income was being increased. And then at the federal level, they also did making the deduction smaller, expanding the base, those are two things that increase the amount of taxable income you're reporting. Federally, they then expanded the tax credit for taxes paid to a foreign country. So generally, I think at the federal level, they were estimating some positive revenue impact from those changes. But, expanding and reducing deduction on one hand, but mitigating that by really expanding the credits paid to foreign countries. Vermont we don't have credits for taxes paid to foreign countries. We rely on the single sales apportionment factor, right? So when you had Carl Davison, he presented you their idea of saying, well, they have these deductions and these credits to sort of count for how they're apportioning things. But that doesn't really, in what he was saying, make sense in the context of the state where you're apportioning. So the argument there was rather than have these deductions on this income flow through to Vermont, why don't we remove the deductions and have single sales do the apportioning for us, right? And so, if you remember back to that equation we had before, what this does is on that left-hand side of that equation, it was going to increase federal taxable income for these corporations. But it wasn't going to increase sales into Vermont in the apportionment factor, but it would increase the denominator with factor relief. Because the tax department would allow you to include in your denominator the revenue sales associated with that income that had been being deducted. We're getting close. So there's the research and development tax credit. Again, this is a state level credit. It's a state level credit set equal to a federal credit, but it's specifically only for R&D expenses that occur in Vermont. And again, the tax department publishes a report every year listing all the companies that take it. It is non-refundable, but there is a 10-year carry forward if your liability is not enough to be able to fully use the credit. And again, what this language is doing is increasing the percent of federal credit from 27% to 75%. And this was actually one area where the effective date was prospective. It's going to be for tax year 26. So showing up, no, tax year 27 showing up in fiscal year 28. And so I didn't include downtown village tax credit and down payment assistance because I know you all have heard about those programs many times. So for brevity's sake, no specific slides for that. But what I do have is all these different changes put together, all this conforming and decoupling, extending, reducing. These are the estimates that were, consensus with the tax department. They worked with us very closely throughout this entire process. Were very helpful. So when all is said and done, for fiscal year 26, the one we're in right now, about a $4 million reduction in revenue compared to baseline. For fiscal year 27, that you're building the budget for right now, about a $14.5 million increase, and then looking out for the years, around 14 million going forward. And this is a table from the fiscal note, which I know you've seen, but this is sort of everything in the bill put together and showing how this affects what's being done for all three major funds.
Is this the bill as we passed or is it not passed?
This is the bill as it's coming back to you. Yeah, so you can see here, downtown village tax credit for your version would have been $1 million. But so just in a reminder, in this bill, you have the increase in the purchase and use percentage that goes to the transportation fund that sends about $10 million more to the transportation fund. And so that also decreases the education fund by about 10 million, but the allocation of meals and rooms revenue is being increased in the education fund. So about $10 million is backfilling the education fund that way. And then lastly, all the revenue changes that you made, that is essentially, if you look, you have to look at fiscal year 26 and 27. But if you put those two together, that essentially is making the general fund whole. So really, all of these changes are funding a $10 million increase in the transportation fund while keeping the other two major funds largely harmless. And one thing that is important to note is that the changes in those percent allocations for the meals and rooms and purchase and use are being done statutorily. So those are permanent going forward. You don't need to reauthorize that every year.
Yeah. Can we look back at some point at just the projections for those different funding streams? Maybe I've just been reading about FERC recently, but do we know what's going to be happening?
Yeah, Pat or
No,
you guys shared
did that.
there was a presentation about it with all the three.
I just,
I know-
it's his name, that's on.
It was Chris
Back and find it.
Yeah, it would have been Chris
Okay,
too, but
I'll find. This one, go back and read
I think
it.
he's coming back here too later this afternoon.
I can read it too.
I think it was the week or the week before we voted it out.
I think
But I think it's also the only time he testified on this bill. Maybe not, I don't know.
and I think my question is, we know that, because non-property tax revenues are not growing as fast as some other sources, we're gonna get this growing gap, and if meals and rooms is.
He thought, so what I remember from the graph was that meals and rooms and purchase and use were growing at the same speed.
Okay.
That was the takeaway.
and of course, there's always the consensus for, they do 5-year projections and that.
Yeah.
So, that's all I have prepared today. So
Thanks.
unless there are questions, I'm happy to cede the floor to Kirby if you want.
Any questions before the floor is seated? Okay. I'm gonna have us take a 5-minute break, but just get out of this very warm room. Okay. It's not just me, right?
No.
No.